Please welcome the panel on Global Investment Outlook, Investing in a Shared Future, moderated by CNBC anchor and correspondent Dan.
Okay, good afternoon, everyone. Thank you so much for sticking around for this next conversation. Dan Murphy with you from CNBC, and I am absolutely thrilled to be joined by another stellar panel here at the Milken conference. And thank you to Milken and to all of the organizers for bringing our panel together. So please join me in welcoming His Excellency Waleed Al-Muhairi, the Deputy Group CEO of Mubadala. Sir, great to have you. Katie Koch is the President and CEO of TCW. Tony Manella is the co-founder and president of Eldridge Industries, and Anne Walsh is also with us. She is CIO of Guggenheim Partners. So welcome again to you all. Let's dive straight into the conversation. And I think important to really set the scene here, given we are in Abu Dhabi, talking about some of the pools of public and private capital moving here and the investments being made. So Your Excellency, first to you. Look, no doubt you've seen the headlines because you're a key part of it. Abu Dhabi, now the capital of capital, so to speak, outranking Oslo as the city with the most sovereign wealth fund capital under management, $1.7 trillion as it stands now. How are you being active in the region and globally? And just walk me through how you got to this point.
Thank you. I think, first of all, it's great to be here, and it's wonderful to see so many familiar faces. At the end of the day, ultimately what you'll find about Abu Dhabi and the group of investors that really make up Abu Dhabi is that, we share a dynamism, we share an agility, and the great majority of us are thematic investors in terms of how we look at the world. And so when you put all that together with a great regulatory environment, an environment that encourages capital formation, where you see more licenses being granted to investment advisors, hedge funds, other types of funds, whoever else it might be coming to this part of the world, what you get is a very positive, virtuous cycle that really makes Abu Dhabi the capital of capital. But at the end of the day, each one of us is defined by our own kind of unique strategy and our own unique view of the world. So if it's worthwhile, maybe I'll just take a few minutes and talk about what we do as Mubadala. So Mubadala is Abu Dhabi's direct investor. And so as you probably know, we are owned entirely by the government of Abu Dhabi. And really we have two halves. So we have an endowment half, which is called the Abu Dhabi Investment Council, which is generally an indirect investor and is really quite similar to the Harvard, Yale, Princeton, Stanfords of the world, Texas A&M or whatever it might be. And then you have Mubadala, which in large part is a private equity investor. And when the two of them are working in harmony, you will see the growth that we've seen in the past. And I think that the last 5 years have been tremendous, just from a trajectory perspective. And if I were to think about what the next 5 or 10 years are going to look like, more of the same. Because we are so conviction-driven in the way that we deploy capital, right now, looking at the world, whether it's the United States, whether it's Europe, whether it's Asia, you find themes that I think propel you forward. For example, in the United States, we see a period of growth and prosperity that's likely to be there for a good amount of time. Of course, you could have inflation, you could have other things, but again, when I look at risk-reward, looks like a pretty good picture. When I look at Europe, a lot of people will say, well, Europe is a little bit challenging, and I won't necessarily disagree with that point of view, but it doesn't mean there isn't opportunity. If you're tactical, you can find special opportunities and you can make outsized returns. And Asia, I think, has been everybody's growth engine for the last few years and is unlikely to change. They have so many things going for them. And so you put that together, I see a really interesting 5 to 10 years ahead of us.
So the Mubadala house view on 2025, more bullish than bearish with a bias to the US, fair to say?
Yeah, I think, look, cautiously optimistic is probably the right way to do it. We tend not to be very volatile or move to extremes, either in prediction or in the way that we deploy capital. And so what that means is, look, I think everything seems good at this point in time. It doesn't mean that things can't go wrong, but more things are going right than otherwise. And so I'm cautiously optimistic.
Okay, I like cautiously optimistic.
There you
Katie,
go.
Koch, over to you because I think you actually have a different view. Katie and I caught up just a couple of weeks ago in Saudi Arabia on a panel at FII, and you said you're a little more bearish actually on the outlook, particularly in the United States. Can you unpack that?
We're going to get to a big debate here. That is true. We're more balanced, but it's actually not so much the macro outlook. I agree with a lot of the comments that you made, and the U.S. has truly proven to be quite differentiated and exceptional over the last few years in particular. But it's really around valuations, because obviously the macro can be whatever it is, but there's still a price that you have to pay for everything. And so the thing that gives us pause in many places on our platform is just how expensive that risk assets are right now. So I'm going to take a quick step back and then kind of lay out the case for why that is and then where we see value and opportunity. So I have the privilege of leading TCW. It's a global asset manager. We manage about $200 billion of private credit, public credit, and public equity. And we've had the privilege of managing assets in this region for 41 years. So it's great to be back here with many of our long-term partners. And when we look across our portfolios, obviously in private credit, we kind of underwrite like there'll be a recession tomorrow. But in public fixed income, we do have to take some of these views and think about valuations in particular. And this is what I would say. If we take the broad fixed income market and just split it between rates, credit, and securitized, and you look at how we're positioned in our liquid portfolios, we're at our maximum underweight for credit. And the reason for that is that IG credit spreads right now are about 70 basis points. And we have a lot of fixed income experts up on the stage. But if you look back over history, basically 100% of the time when OAS spreads are at these levels, returns have been negative. And so just the valuations are so demanding in credit that while, yes, the macro backdrop is constructive, it's priced for perfection. And we have to live in a world of probabilities. And we just don't feel like we're getting compensated for that risk. In the securitized market, we're very overweight agency MBS, usually obviously trades at a spread discount to credit. Right now you can pick up a spread premium for that, and so that's a part of the market that we like. And then from a rate perspective, because we're a little bit more cautious, we are a little bit overweight duration, and we're doing it at the very front end of the curve, because we think the Fed's likely to cut a little bit more than's priced in. And that gives you a sense of how we're positioned across the liquid portfolio. And so for us, we're willing to just hang out in agency MBS, carry over IG credit, be liquid, be conservative. And one thing is for sure, something will break. We'll get volatility back. We had it for 5 minutes in July. I think it'll come back again. And then we're going to step up and be liquidity providers when other people can't or won't. That's what's worked for us over the very long term. Just want to end with one comment. Other place that we see value that a lot of people aren't talking about, but actually this region's been I think quite prescient on, is emerging market debt, particularly hard currency debt. The spreads of EMD high yield are very attractive relative to domestic high yield market in the US. We've actually had an additional $2.5 billion of capital just from this region into EMD hard currency in the third quarter alone. So we are seeing interest. Wealth interest will follow, but the sophisticated institutional interest is there. And just an example of, and I want to say this here because I want to thank this region for making this trade work. One of our biggest positions was actually in Egyptian bonds, which we initiated in 23 after the country went through a lot of pain in 22. And we just thought for a variety of geopolitical reasons that it wouldn't be allowed to be a failed state, and the bonds were at 50 cents on the dollar. And then the IMF came in and improved their program, and of course, the UAE stepped up in a big way to make investment, which has brought in other FDI to Egypt, and those bonds are up about 50% on the year. So there are opportunities in EMD broadly, and then specifically in certain countries that to us offer better risk-adjusted returns, better value than what can be found in certainly parts of the US credit market.
Just a quick follow-up on that.
Yeah.
You said something will break. What breaks first?
Usually equity markets followed by credit if it works the way that it has. And we haven't talked about equity here, but I think people are aware that we're at the pretty much most expensive valuation that we've been in equity markets, even taking out the Magnificent Seven, very much priced for perfection. So usually what happens is they roll over quickly and then credit spreads will widen. But if you think about fixed income, the thing that will break first will be the riskier parts of the credit market. And I would just end, I think we're going to talk more about private credit here. I would love to do that. We're very involved in the private credit market. We've actually been investing in private credit for a quarter century. And there are stress in that part of the market, in the middle market. It's not showing up in default rates yet because everybody's amending and pretending and extending or whatever word you want to use. But we are definitely seeing some signs of pressure in certain parts of that market. And I bring that up just because when you ask what's going to break first, it usually is equity followed by credit. It is possible, and we should be open to the possibility that some of the breakage might be more, there might be more opacity on that, might be harder to see, because it's some of it's going to be in private markets instead of traditionally where it would have been in public markets. And for us right now, the biggest pipeline opportunity that we have is actually in rescue financing, so providing rescue loans into middle market U.S. companies. We're slow on deploying capital in regular way direct lending because it's super crowded, but there's phenomenal opportunities in rescue because of these upside down capital structures that have been put in place and the high interest burden for those companies. So I just end by saying, even in the absence of a recession, and I don't have the proverbial crystal ball, so I don't know, I would assume eventually we'll get one because I still believe in business cycles, but even in the absence of that, the rate levels is putting burdens on some of those companies.
Okay.
So that's where we see opportunity, and that's where things could break first.
Okay, fascinating.
Yeah.
Thanks, Katie. Tony, jump in here, weigh in. I'll get you to react and respond to what you've just heard, but also walk us through this announcement you've made today regarding the new fund and the new office and the macro and market view into 2025.
Sure. Well, first, thank you, Dan, for your coverage of the region and for hosting this panel. I think over the past 10 years, I think one of the themes in the panel is shared prosperity. I think that your coverage is finally starting to punch through in America and over in Europe and tell a different story about the region than the narrative that has been told historically. So I appreciate that. And Waleed, congratulations on the announcement this morning of Silver Rock.
Thank you.
We've worked with Carl and team over the years and have originated a lot of assets with them. And so you've got a great group that you've invested in there. The announcement that we had today is a consolidation of our investment management businesses that we've really started beginning in 2015, 2016 as Todd Boyle and I left Guggenheim Partners and established Eldridge and acquired Security Benefit from an initial shareholder group that was led by Guggenheim. Instead of allocating to Guggenheim, it made sense for us to build our own platforms. Initially, it made sense to silo those. We've now reached the point where, as we consolidate those businesses, we have about $74 billion of AUM. Most of it's our capital. Eldridge Industries is a $80 billion balance sheet, about a $15 billion equity market cap. And we own an insurance business called Security Benefit. That insurance business and an insurance business called Everly is consolidated underneath an Eldridge branded holding company that's wholly owned by Eldridge Industries, and will also own all of our investment management businesses, which include asset-based finance, diversified credit, structured credit, sports and media, and entertainment, and then a real estate credit fund, which we've really been able to originate in the 9 to 10% ranges on both asset-based finance on an asset level before you put any leverage on it, and as well as in opportunistic real estate lending, which is largely in key gateway cities for construction development, and we're in Miami, New York, London are largely where we're doing that.
Really fascinating. Yeah. Sorry, Katie, did you want to?
Yeah, I wanted to say a couple of things that Tony didn't say about himself that are exceptional. Just wanted to observe. So Eldridge was actually, I give you guys so much credit for understanding earlier than pretty much anyone in the market the relationship between insurance companies and asset managers, and how incredible that combination can be. And that's something we're looking for in having a partner, as with Nippon, but you guys were very early to that, which is exceptional. And the other thing that they did was take a stake in the Dodgers. So I think we should all congratulate them for that, who won the World Series this year. So we should say amazing. Another example.
Guggenheim has a stake in the Dodgers as for.
Yes, a lot of great investment picks.
There's a lot of friends on this stage.
Right.
And dive in here as well. Also, react and respond to what you've heard, but specifically I wanted to ask you as well, you know, we're more than 15 minutes into the panel. I haven't mentioned Trump yet, so I thought maybe we could start there.
That could be a new record.
Yeah. So what's your view on Trump 2.0, some of what you've heard him announce so far, and how much of the policy that has been revealed do you actually think will be put into practice, and what impact is it going to have on risk assets, equity markets, the macro into next year?
So again, thank you so much for having me today. It's great to be here. It's great to be here in Abu Dhabi and amongst this august and friendly group of people who I've known so many years, all of you. So in the land of, we'll call it Trump 2.0, we know a few things that are going to change as we move from politics to policy post the election. And there's still a great deal of policy uncertainty, but I think we know a few areas that are going to be critical for the new Trump administration. And they fall into the categories of immigration, trade and tariffs, and taxes. And I think the directions of travel are fairly clear with regard to the policy. Immigration will be curtailed, but it was already starting to decline. And we could see that in the migration numbers in the U.S. So the question is, does that have an inflationary impact in the U.S. as the labor pool starts to decline as a result? Taxes, the direction of travel is we're going to see, I think without a doubt, an extension of the Trump tax cuts from the first administration. And the question is, do we get more tax changes or tax cuts? And of course, that requires Congress to be involved. And so that policy aspect has yet to be proven out, and we're going to have to wait for a while. And by the way, the timelines for taxes in particular, it will be a while before there's an ability of Congress to address those matters. And then finally, trade and tariffs, which of course are a topic globally. And I think in this particular case, I might take a slightly contrarian view with regard to tariffs generally. I do believe that the Trump administration will use tariffs more as a policy negotiating tactic, in particular to address some of the social issues that the Trump administration once dealt with. And that would include reduction of particularly the drug trade that comes along with the illegal immigration from the southern border in particular. And I know he's already had outreach with Mexico and China with regard to drug trade. And I think that's a very important social ill that the Trump administration wants to address. With regard to tariffs generally, I would take the view that we are probably not going to see an across-the-board tariff policy, but much more targeted. And I think that that is going to turn out to be less inflationary than was projected. And I think as a result, the global central banks will probably be able to, and the Fed in particular, be able to see inflation decline. And as predominantly a fixed income asset manager, I think this is going to be meaningful for where we find ourselves with U.S. rates. So if we think about where we are, I think we're in a trading range. We've been in a trading range on the 10-year Treasury for the last almost 2 years now, and I think we're going to stay there. The question is, what does that range become? And for my view, it probably is about a 4.5% on the high end and a 3.5% on the low end. There is still a huge amount of fiscal expenditure happening in the U.S., and I don't see much changing there. A small amount of reduction of deficit spending, but in the short run, I don't see magnitudes. I know we have Doge coming in, and I'll follow Waleed's comments. I'm cautiously optimistic, actually, and this is one of those areas where, as a fiscal conservative, I would really like to see less fraud, waste, and abuse in the U.S. government system, and we'll see if they have a real ability, without touching really the non-discretionary social welfare programs, Social Security, Medicare, Medicaid, from being able to be addressed, and whether it makes a difference on the margin, and is that sufficient to really have an impact. So where do investors need to look for relative value in a world where, frankly, volatility in fixed income continues to be elevated? And risk premiums, following Katie's comments, risk premiums in equities are relatively light, and the VIX is lower. So you see less volatility in equities, much more in fixed income as we ride this trading range. By the way, that's an actionable investment idea because we can actually extend duration, to Katie's comment, or shorten duration depending where we are. But that also leaves us a lot of opportunities for other places to invest. And credit is one of those areas, as well as hard assets, real estate, and infrastructure. And that'll be part of some spending programs that I still see the government continuing to push out and not pulling back, even under the Trump administration.
I like that. Let's talk about real assets just for a second, because I know that's something that you wanted to pick up on. Infrastructure, real estate, data centers, industrial parks. How does all of this factor into your investment strategy, particularly if Trump comes back and we see friendshoring, nearshoring, a focus on domestic U.S. production? What's the impact on real assets?
So I think in this particular environment, where we have generally more stable rate backdrop, generally accommodative, relatively speaking, Fed. The trajectory is for lower rates. This is very good for real estate in particular, but also the infrastructure. I mean, we're just underinvested relative to where we need to be, and that's not just in the U.S., that's globally. And there are a number of trends that are happening. Digital build-out, artificial intelligence. We are nowhere near the finish line with regard to artificial intelligence, and we have to build the infrastructure to support it, power to support that, water. All of this is causing the build-out, the reshoring. Part of the Trump administration, dare I say, for the Chinese in the room, there is going to be targeted tariffs. That is one of the places where I do see that happening. And so as a result, we're going to see the shift continue, which started during COVID. It's going to continue of friendshoring and reshoring. Southeast Asia has a big benefit. India, this region, to be bigger trading partners with the U.S. in particular. And so there's going to be more manufacturing build-out, logistical networks, and transportation equipment. It's going to be an amazing amount. Trillions of dollars are going to be invested, and we still have the Inflation Reduction Act and the infrastructure build systems built into the fiscal policies, and so there's going to continue to be subsidies in this particular area. All of this is good for real estate, and it's good for infrastructure. And what's interesting is now they're merging. The lines are blurring between these two categories of investment. As you think about a data center, it's both a real estate play and an infrastructure play, and we're seeing that across many different sectors. Finally, population shifts are going to continue, and there is still a lot of build-out with regard to residential that's going to continue to happen. So there's a lot happening that is going to be very opportunistic.
Waleed,
all that makes you cautiously optimistic?
I think I'm a little bit more cautiously optimistic when it comes to that particular space.
Katie's going to come off the panel pretty bullish.
Tony, you're talking about structured credit as an asset class. Just walk me through some of the trends you expect to see, particularly on the ETF side. I know it's a business you're exposed to. What's the opportunity next year?
So we've been big investors historically in the CLO asset class. It's probably the single biggest exposure that we have at Security Benefit, our insurance company. It has allowed us to, in a rising rate environment, have earnings that have accelerated. And so we've historically been in the middle of the CLO liability capital stack, including some of the equity. As the market and the regulatory environment has shifted, we've done less equity right now, but have still been fully involved in the CLO liabilities. And it's an asset class that's historically very it's misrated. It's something that we fundamentally believe in. We've designed retail annuity products to be able to deliver that exposure to clients, to our customers, and there are plenty of ETFs out there that now, allow for investors to get, direct exposure to CLO, AAAs or CLO triple Bs or some mezzanine tranches, which stretch down into the between triple Bs and double Bs, and you can, get yields. I think the AAAs are, relatively are risk-free, and they're, right now, base rate is 4.5%, and you get 130 plus basis points on top of that. So you're pushing, 6% right now, for CLO AAAs, and that's, how we think about, investing our balance sheet. Is okay if that's the risk-free rate effectively that we can achieve. How do we, and how do we achieve, more than that, and what type of risk are we, taking on? And as you move down the CLO liability capital structure, right now in the triple Bs and the double Bs, you can get into the call it another 400 basis points over the risk-free rate, 300 to 400 basis points.
Do you have an ETF or no? You just do.
There's plenty of ETFs out there.
But you don't have your.
Panagram, one of our investment management businesses, does have an ETF out there. Yeah.
Katie, you want to weigh in on that as well, regarding private credit and private markets, opportunities that you see moving forward? You spoke about fixed income before. You can weigh in on that as well. But what about within private markets? What do you see?
We do in the private market space. By the way, we have a AAA CLO ETF too, a CLO, if anyone's looking in that space. And I agree. I just want to say I agree with everything that you said, and I think it's a very good product for retail investors to pick up excess yield at low risk rate, and a good alternative to money market funds. In addition, institutional investors have done it for a long time, but it's good to have that for wealth. On the private credit side, you asked private markets generally, we don't do private equity, so we're only in private credit. I wanted to make that comment first. And I will just you asked about trends, so very quickly, as I said, we've done private credit for, I said earlier, 25 years. In 25 years, we've had 6 losses. We're in a very specific part of the private credit market. I would observe that we think it's crowded, that there is some bad lending happening broadly in the market because of how much capital is being put to work. The part of the market that we're focused on is a little bit less crowded, but we're still very slow on deploying capital. So we're in the part of the market that's 25 to 75 million EBITDA, roughly, companies. We are very covenant heavy. We are very diligent heavy, which means we say no the vast majority of time to lending to these companies. And I kind of alluded to this earlier, but people feel that this market's healthier than it actually is because defaults haven't gone up yet. They've actually gone down, but that's because of what we said before, people being able to extend capital. We do see some opportunity there, but we are slower deploying capital. Origination is so important in this market, and I think as 98% of managers started post-GFC, which is 2 issues. First, they haven't gone through multiple rate cycles, and second, I think you'd agree not everybody has an amazing origination engine. You guys obviously do, and you have a lot of proof of that. I think we do as well, but there are many commoditized players in this space, and we think origination is going to be incredibly important going forward. 80% of our loans by size are self-originated for us. So this is just like our colleagues also, our peers rather, at Eldridge, Guggenheim. If you've been in the market a long time, you have great relationships, you can find those yourselves and you're not dependent on the sponsor market. I think that's going to be even more important going forward. And we recently announced a partnership with PNC Bank. So that's going to be a continued source of differentiated origination for us. We've launched a JV called Steel City TCW, where we've both put in substantial capital. We've actually both put in people. And it's a counterparty that we've done co-financings with for 15 years. And that's going to be a source of great origination for us in that vehicle and then broadly across the platform. I already mentioned rescue, but I'll end with that. Like that's probably where we see the most upside because of the amount of companies that need help with the interest burden, who actually, it's a little bit sad, honestly, in the US. Many of these family-owned businesses, the operating business is fine and the top line is fine, but because of how private equity structured them in 21 and 22, they can't get out from under their own interest burden. And so there's a lot of opportunities to get involved and help those companies restructure. You get a high current coupon. There's a PIK component that can bring you equity and warrants. And so you can get equity-like return, but be in the very senior part of the debt structure. That's probably where you see the best opportunities from here. And then finally, I just wanted to end on asset-backed finance, or we've done securitized investing. Guggenheim's done that very successfully for a long time too. We've managed about $90 billion of liquid securitized assets, which I referenced earlier. We do see an extraordinary opportunity of more of those assets going private, and that can be structured as IG or MEZ. And the reason I bring that up here is because I told you credit we're a little bit more cautious on because of valuations and also where we are in the economic cycle. This is exposures that you can build with excess yield over IG or high yield, depending which part of the market you're targeting. And the returns are, first of all, self-amortizing, lower duration. Generally, you can make them bankruptcy remote, and they have low correlation to corporate credit. And so if you're looking for something with good yields and low correlation to what's happening in corporate credit, I think securitized, but asset-backed finance in particular could be really interesting.
Okay. Waleed, I wanted you to respond to something that Anne mentioned earlier, and I asked Anne about Trump 2.0. For Mubadala, North America is the primary geographic focus. What changes do you see, and is this something that you actively think about when it comes to exposure in the US?
So before I get into that, actually I want to jump into the private credit discussion, if I may. I think it's been discussed by the three experts to my left. But look, we are, out of the four people sitting on this panel, we're probably the newest entrants to the private credit space. But we've made a couple of choices that in many ways I think build on what everybody has talked about. So number one, we're very, very senior. So we've only done senior secured lending. Okay, and so that's 98% of what we've done. We have been a little bit more flexible in the capital structure for that incremental 3%, but the great majority is still senior secured unitranche type exposure. And listen, for the last 4 or 5 years, it's been great. We recognize that it's not going to be as great as it was, but we think it still has legs and will be fine. So that's number one. Number two, our approach has been very platform-centric. And the single most important kind of realization that we have is while we have underwrite capability, while we can do the full cycle, we want it to be with the best originators that we possibly could, because that's obviously the hardest thing to replicate, especially for somebody who's halfway around the world. Yeah. And so when you find that, which I think we have with the 6 partnerships that we have, 4 of which are in the United States, Europe, and then in Asia, we've got the recipe for something that I think is working. But at the end of the day, I really want to echo what everybody has said. So if you are relatively senior in the capital structure, if you understand the importance of origination, then you may not get the returns that we've seen over the last 3 or 4 years, but you should still do reasonably well. And so far, we're still seeing very equity-like returns from a space that theoretically has a little bit less risk. So that's kind of private credit. We are becoming a little bit more hybrid. We are doing some more mezz. We are playing with warrants. Again, it's still a small part, but I think it will increase over time, given, I think, the themes that everybody spoke about.
I think the good thing about the private credit market, and there's been a lot of attention that's been paid to it, is that you have a principal-to-principal transaction, as opposed to a bank originating to distribute. And, banks used to originate to distribute, based off of, and compete, with private equity firms, based off of, rate, then covenants, and then they took structure. And so there's a lot of liability management exercises that are going on right now. And so if you have a detailed credit team that can sift through the documentation, I think a private credit solution that we can provide, that Rick Miller at TCW can provide, is an exercise that dissects that document, actually goes in and potentially buys an asset on a sale leaseback, and if that company goes through a reorganization. We've seen in our asset-based finance strategy, we've seen 105 cent in the dollar recovery in those type of transactions. And so if you encumber absolutely essential use assets, whether through a security interest or through actual ownership, if it's actual ownership in the United States, 120 days after you're inside of bankruptcy, the debtor has the obligation to either accept or reject the lease. And so you really got the the situation under control, and you can make a great rate of return and not take a lot of risk. And that's a form of private credit that's not talked about a lot out there.
Okay, very interesting. Well, we have about 5 minutes left, so I wanted to maybe
Wasn't Waleed going to talk about Trump?
Yeah, I'm definitely getting there.
I wasn't actually.
Evading the answer.
So here's.
This is called the pivot.
Don't
And it was
Don't bring that back to
expertly executed, Waleed. I give you credit for that. It was expertly executed. We have about 5 minutes left. So what I wanted to do is also just get your take on one thing to watch in 2025 or a key risk that's coming up on the horizon. Katie's already spoken about what breaks first, so maybe we can also unpack that. But Waleed, first to you on 2025. What's the risk? And back to my question about North America and that being the geographic focus for Mubadala. Under Trump 2.0, what changes, what stays the same?
So maybe let's start with risk first and expand a little bit more because we're global, right? So when we look at risk is conflict. So there's geopolitical conflict.
Of course, we haven't spoken about the Middle East either.
Well, and it's not just in the Middle East. And so we're looking at that. We're looking at, obviously, climate change. Everybody's spoken about it, but we need to keep speaking about it because that's a risk, and it's it's causing massive loss, it's causing dislocations, and so that's certainly number two. And then I think number three, again, so we've all spoken about inflation. We all know that it may or may not come. What we haven't spoken about, and which people don't spend a lot of time thinking about, is what's going to happen to the U.S. dollar. So right now we've been living in a pretty strong dollar environment, over the last few years. And that may or may not continue going forward. Right now, I've got my own thoughts about it. I personally think there's a bias towards the dollar potentially weakening, and so, a lot of folks haven't lived in that world, at least not recently, right? So we also need to think about how we're going to position ourselves for that going forward. So look, I'll end where I started, which is the United States. Notwithstanding, the incoming administration or whatever else it is, still is the best risk reward that we've seen by a country mile, if I may use that. So if that's the case, yes, private equity has a DPI problem. Yes, there are valuation issues. Yes, the markets are at an all-time high, but it's relative to everything else, right? And so while there is growth in Asia, risk reward is not the same. And while there may be opportunistic opportunities in Europe, again, they're hard to find, and friction is high, at least relative to the United States. So if the incoming administration reduces regulations, as they've been talking about, and if you see a tamping down of regional conflict, which is also being said by the incoming administration, then look, I think all in all, in balance, growth should continue, right? Yes, again, it's not going to be a straight line. Yes, there could be some volatility, but again, I actually see more bias to the upside than I do to the downside. Fully recognizing what everybody has said, fully recognizing that we might have to switch between asset classes and do different things. But when I look at the United States, there are alternatives, but not many of the same same scope that have the same absorptive capacity that the U.S. does.
Just on the conflict point, I mean, we spent time in the region. We've been coming here for 15 to 20 years, and it's been amazing the amount of progress that we've seen here in the Emirates under your leadership, in Doha, in Riyadh. I think to Anne's earlier point about infrastructure, the infrastructure that's been built up here is very impressive, especially relative to what we have in the United States and the amount of investment that we need in order to keep up globally. And so there's a lot to lose. And so I think cooler heads are going to prevail, and I'm not as concerned about the conflict in World War III necessarily erupting when we've got the top I don't know, 6 market 5, 6, 7 market cap companies in the United States are worth 30-something trillion dollars, $36 trillion probably, and so back in 1995 the top 5 were less than $400 billion in aggregate, and so you've had a massive amount of wealth creation, and there's just a lot to lose, and so the incentive to to really incite conflict, I think, is not there, and hopefully cooler heads, do prevail.
Okay, a minute and a half. Katie, just your final thoughts on the biggest risk next year?
I mean, I kind of said it with valuations that the one word would be complacency in the market. And then the only other comment I wanted to make around growth, which the reason we're more balanced on it, two brief statements. The first is this election showed us one thing that Americans definitely care about, which is inflation. If they were happy with the economy, we wouldn't have voted a different president in. The economy's not working for everyone. And the second, and that means that there'll be a governor on growth. I believe that there's going to be more of a governor on pushing for growth than what people expect. The president can't get reelected under the current constitutional structure, but the Senate needs to get reelected. And I think they're going to be very focused on that, in addition to the central bank. And the second comment I just wanted to make is that we have a problem in terms of our current account deficit as a percentage of GDP. We've been able to do it because we have the exorbitant privilege of being the world's reserve currency. The same situation has caused the French government to collapse this week because they're not the world's reserve currency. I don't know when I can't say it's going to be a problem in 25, but I also think that will be a governor on growth, particularly if the 10-year misbehaves around that.
But the department, I wouldn't bet against Elon Musk and the Department of Government Efficiency.
The Doge.
Yeah,
Bet against it.
I mean, we're going to take costs out, and the dollar's going to strengthen.
Watch that
There's
space.
only so many costs you can take out.
And you get the final word.
Sorry.
Key risk for 2025. What is it?
I still think geopolitics is significant. I didn't expect martial law to be declared in South Korea, and we could continue to see previously stable regimes experience political and geopolitical uncertainty. And then I also agree that fiscal policy in the U.S. is going to be dominating the conversation over the next 2 years, and the down ballot government positions will be important. So I think that will continue to keep fixed income volatility high in the U.S. as the fixed income markets react to that.
I really enjoyed our conversation. I hope you did as well. Ladies and gentlemen, please again make them feel welcome. And Tony, Katie, and Waleed, thank you again.
Thank you.
Please remain seated as we set the stage for the next session.